Hello, everybody. I'm Rob Smith at the In the Black Quant Edge VTF at T3 Live, and always get excited when I get to speak to new people, especially if you've never heard any of this before, because a lot of what I'm going to show you tonight is I'm going to show you the biggest miss in possible any industry's history. Our industry has completely missed the dominance of the broadening formation, and a lot of it comes down to the folklore of technical analysis. Now, a lot of people say, oh, I've done a lot of work and I do a lot of research, but mostly it has come from reading other people's books, not doing your own stuff. And so I started when I was 15 years old on the CBOE. I'm 52 now, I'll be 53 this month. And I started full-time in 1989, and I started going through every book, every chart, 2,500 to 3,000 charts a night, trying to figure it out. And what I've discovered was the biggest miss in history is the dominance of the broadening formation. Every book says that the broadening formation is rare. CNBC almost never mention it. The CMT exam itself, the Certified Market Technician, says it's rare. And for those reasons, it took me as long. It took me 20 years to figure it out. So what I can do about that is I can show it to you and I can prove it to you. And hopefully that's going to enlighten you on how things really work. So what I did was, personal history here is that I started off on the stock exchange in 1989 full-time. I was an individual trader, I was a listed specialist, I was an OTC specialist, and did a lot of my own work. And I would go through 2,500 to 3,000 charts a night after reading all the books, which I'm not happy about because they're false, as I'm going to show you tonight, to try and figure out what exactly was going on. And so I discovered that the broadening formation dominance in late November. It was a Fed day. And what was going on, obviously, and if you haven't been around a long time, Fed days used to be a real big deal, especially when they're trying to cut rates or what's going to go on. And I would see, and if you've ever seen anything where you know news is coming out, you've seen this phenomenon, where it's good news and the price spikes higher and then jets lower and then rockets to new highs. And I was like, well, why would it do that? And the reason that it does that is that because everybody's sitting there getting ready to, if it's good, we're going to buy. If it's bad, we're going to sell. Boom, they all hit the buy button on something good. That crowds the trade. It leaves an order vacuum to the downside. The first profit taker takes it right back through. The guys who held off on the short side say sell, false breakout. They slam it. The news is actually good, and it creates a double vacuum to the upside. I'm going to show you that this not only happens in a very fast amount of time, but it happens over and over on much longer terms because trades become crowded. I'm going to show you all that stuff. And so what I started to do after 2009, I was writing a newsletter, and it was still brand new to me, but as soon as I saw that happen on that Fed day, I was like, that's a broadening formation. And I went to my books, and they're like, oh, it's rare, it's rare, it's rare. And I'm like, I keep seeing it. And after that, I went back and I started drawing this stuff on everything, and later was able to quantify it, as I'm going to show you. And it was like, this is on everything. Everyone has missed this. And so what I did was I started In the Black newsletter, and later went to video, and now I'm on the headset all day. And so what I did was, here's going back in history, May 3rd, 2010. And what I did was, I was drawing the triangles on the Dow Jones, and what I did was, in here, if we get back down to here, come on, uh-oh, why is this locking up on me? Okay, 1 second. What I did was, I made a case for the Dow going to 20,000. Oop, is this the wrong one? This is May 3rd, I'm sorry, we're going to March 8th. March 8th, what I did was I made a case for how the Dow could go to 20,000 based on the size of these triangles. Now, I never say that I call stuff because there's a lot of things that can happen between, but when you understand how you can gauge magnitude with this stuff, as I'm going to show you, In the Black technical case for Dow 20,000 was that people were misinterpreting the pattern. Where you might, if you were around back then, here's the S&P, and they're talking about this is the mother of all double tops, which is not true, and they're drawing this and saying, oh, it's the mother of double top, it's going to zero. And what I did was I went in here and I said, well, what? This was actually higher than that. And I said, and this is lower than that. So what if this is an actual broadening formation in the S&P? And then if we take it down to the Dow Jones, people had it like this, and move that line down. All right, what if it's like this? You can see how archaic I was at the time, and I was still figuring this out. Dow's at 10,000, all right? And so at that time, what I was saying is if this is true, the Dow averaging returned 5.3% during 20. So this seems a bold call, but it truly equates to back to business as usual. However, if we revisit the idea that we're actually looking at in some symmetrical inverted triangles, which I called them back then, it says it may accelerate much sooner, which it did, right? Obviously, we got to 20,000 a lot faster than that, which would be fine and say, well, Rob just made a bullish call, blah, 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 all right? May 3rd, 2010, all right? What did I do? I went in there and I said, I started seeing these triangles again, half triangles in the Dow, like this. And then I matched it up with the VXX, which is very weak, this smaller triangle in here, but this is a history of just decaying. And then I matched it up with a measured move on the VIX. But more importantly, this half triangle, which is actually drawn wrong as I know it now, what I'm going to show you how you draw these things is irrelevant. It's that we know that they exist and how to trade them. And I said here, if this is the half triangle of the VIX, with the VIX at 22 coming through here, the half triangle, you can see how very large potential trend. The results of this would be catastrophic for the market, is what I wrote. And I wrote that on May 3rd, 2010. 3 days later, the Dow Jones dropped 900 points, flash crash. And so at that point, I really knew I was onto something. And I started going back in history and saying, well, is this recent? Is this recent activity? Is this, has this gone on in the past? So I went back in history. Here's the S&P going back to my birth here, 1964. Lower low, higher high, lower low, higher high, lower low, comes up, tests the triangle, gets out, triangle becomes support. Here's 1987, higher high, lower low, higher high, lower low. As you're going to see, even on this continuation, higher high, lower low, higher high, lower low. And then the most recent breakout of this one was the end of the world. Remember, it was the end of the world again. Higher high, lower low, higher high, lower low. And so when you look at things and people say double top, I would look at this and I would say, if you look at that, right, it's not. That's higher, which means if you're short against this, you're gone. And so what you're going to see is you don't have to draw these triangles and know exactly where they are. That's irrelevant. What we look for is once you start pulling back into a range, right, we know that they exist. This is where you can take advantage of it. This, when you get the correction, when you're back into this stuff, as I'm going to get to real soon here. So one of the things that, let's get to some charts because I know we want to see that. Oop, we got to blow up to 1. So if we look at it, and one of my favorite things it just stuns me that people, when you read books on technical analysis, they'll say, oh, there's a head and shoulders, and you know what the next chapter is? A failed head and shoulders. I'm like, are you out of your mind? You're telling me that this could go up or down out of this pattern? Then it doesn't matter, right? It doesn't matter if it can go up or down. So if we look at XLP, oh boy, on head and shoulders, this is some straight out of CNBC. Oh, you see, it's a head and shoulders. Straight back up. Oh, XRT, it's the worst looking head and shoulders ever. Is it? Straight back up. And as I'm going to show you how this stuff kind of works, but just going back towards anything, if you look at the small cap IWM monthly, what do you see here? You see a higher high? Do you see a lower low? Do you see a higher high and a lower low? And then the real move up to the highs? I do. All right. Now, like I said, I'm going to show you how we can prove that, but just visually, you can see that plain as day. Nice hammer pattern off the lows, never stops out, keeps going. Does it work? Because some people say, does it work in all markets? Like, is this just stocks or whatever? If you look at TLT here, just recently today, if you look at the recent daily, you can see this higher high, lower low, higher high, lower low, much bigger move, right? And that's how we can look and gauge the magnitude. And these series will occur all over the place. And does it occur in the currencies? How about UUP? Let's take a look at the monthly UUP. Dollar index. Higher high, lower low, higher high, lower low, back into the triangle, right? Does it happen in Japan? How about DXJ? Higher high, lower low, higher high, lower low, bam, coming back up. Does it happen in China? Higher high, lower low, higher high, lower low, and back up, so forth like that. So even if you're looking at, and you're saying these are these big macro charts, and if you do the SPY, and trust me, I'm going to prove it to you. Right now I'm just showing it to you visually. Right now, that's for fun. If we go to the 1 minute S&P from today, from the ending of today, This is the 1 minute S&P. Higher highs, lower lows, and you can start it from anywhere. Higher high, lower low, higher high, lower low, and then the real move back down. All right, this is a 1 minute chart. So what you'll see is what we want to do, why we look at these macro charts, is we want these bigger moves. Right, you come into here and you're going to get chopped up. Right, and so if we go to QQQ60, you're going to see this here on the 60. Lower low, higher high, lower low, higher high, and then continuation down. You're going to see it in Intel today in the 60. Like I said, you're going to see this in everything, just like I did. But now that I'm pointing this out, higher high, lower low, higher high, lower low, higher high, bigger move down, where we can look for the continuation patterns down through that. So, W day on the daily, you see this? You're going to like this one. Higher high, lower low, higher high, comes down, couldn't make the lower low. Now, what will happen here is you'll believe, okay, we finally got the real move, that's it, until you come back through this range, right? And we know that this pattern exists, all right? And I'm going to show you that in a second, but here we get down and they start crushing it back through. We are looking for continuation patterns because we know this is how things work in something like a W day. So when we get down to like quantifying what's going on, anytime that you have two bars here, there's only three possible outcomes. All right, there's only three possible outcomes. First possible outcome is it stays inside. MU didn't take out the highs or lows of the previous candle, right? That's an inside bar. No one can dispute that. That's one possible outcome. You can't get out of there. The second possible outcome is that you go outside one side of this bar, right? You get outside of that. Now you can still come in here, but you take out one side. One side is taken out, right? So it's either inside or one side gets taken out. Whether it stays out there or not is irrelevant, but it's one side, it has to get taken. There's only three possible outcomes. The third possible outcome is it takes out both sides, an outside bar. That's the only three possible things that can happen on any given two bars setup, right? So the reason that's important is that because this takes out both sides of the range, it has to be a broadening formation by definition. If you define broadening formation of taking out the previous sides of the range on a shorter term time frame, your triangle looks like this. It has to. Like that. Your broadening formation is here. Why is that important? Because it helps us gauge the magnitude. If one side gets taken out and the price returns in, we know we have a potential broadening formation. We have to. It's impossible not to. Doesn't mean it can't re-break to the upside, but I'm going to show you some things on how we can accelerate that probability on that stuff. So if we take a look at IBB on the month, IBB last month was an outside month. It has to be a broadening formation. So was this. It can't not be. So if we break it down, right, you'll see this. Here's your series of higher highs. They came all the way down. This was lower than that, right here. Higher high, lower low, higher high, boom, bigger move to the downside, IBB. If you take a look at Domino's Pizza last month, outside month, right here, check out both sides. And so like I said, when we start to gauge magnitude, we don't have to wait for it to form, right? Right here, once this thing takes out the range and starts coming through here, it is a potential broadening formation, thus a lot more magnitude. Now, I'm going to show you how we can get that probability up. Now, it doesn't mean that broadening formations have to be outside bars on a longer term time frame, right? All I'm saying is that when you have that, that's proof positive that you're back into a broadening formation. You have to be. It's impossible not to be, all right? So if we go to HFC Refiner, right? So on the monthly, no outside bars in here, right? So that's okay because we can still identify the series. Lower low, higher high, lower low, higher high, lower low. And yes, there are going to be times when there's smaller triangles that correct? That's fine, as I'm going to show you in a second. This is also an outside bar, which is fractal triangle. When we got back into that, we get the magnitude back up into the bigger one, and now it comes screaming through here. You can see the months that this thing's been doing once these things get bigger. If you look at something like Perigo here, just on a daily today. First we can go to the weekly. And I don't expect you to get this all tonight, but I want it to sink in, and when I get to this other part, it's going to sink in a little bit more, trust me. So Perigo, outside week, on the daily. There it is. Lower low, higher high, lower low, higher high. And you can draw it from wherever. It goes higher high, lower low. Didn't make it, which would be another series. Lower low, higher low, higher high. But then when it comes back into here, now we got the bigger triangle. So here's that inside bar, right, that broke in one direction. What we want to look for to heighten the probability that these things are going to work and this magnitude is going to work is twofold. One is an actionable signal, and we use a myriad of them that are all for different reasons, but the only thing that is universally true is that an inside bar, all right, didn't take out either side. Therefore, it's an equilibrium, all right? So that equilibrium needs to break, or at least attempt to, and if it attempts and fails, then it goes broadening formation, or it's a clean breakout and it takes it all down. So this is why the broadening formation works, right, here, because we can have an actionable signal which we match with something called time frame continuity. This is how we know it's going the right direction. What time frame continuity means is we want to know the direction of the price from the opening of the month, the week, the day, and the 60. What that tells us is that we have different participation groups we can identify by time and price. So if we go to Perigo, what's it doing this month? Is it lower than it opened? It is. How about this week? Is it lower than it opened? It is. How about today? Was it lower than it opened? It was. It was also breaking an equilibrium. How about on the 60? Yes. That tells me that every known participant is a seller. We also have an actionable signal. The other reason that broadening formations work, and this is very important, most larger moves are going to occur coming back through ranges, not screaming into new highs. Why would that be? Very simple. First of all, we know that all the participants are sellers. That's a good thing for the downside. We know that there was an attempt to form an equilibrium. That's failing and breaking to the downside. So anybody who is trying to buy this and or is long, right, has to have a definitive pivot or level that they will get out, right? How much pain are they going to take? So when you come back through ranges, what you'll see, anybody trying to stay long this thing can just try and stay long against that. Ready? Take them out, right? And this will occur on monthlies, weeklies, dailies, all that kind of stuff. And it adds fuel to the fire where people try and say, I'm going to trade against the pivot. That's fuel to the fire. Because what that causes is that if everyone is a seller, right, and their stops going off, it's accelerating the selling. If I'm a seller and that's happening, I'm not happy about that, right? Because that means I got to chase my sale. I got to keep moving down. Conversely, same things to the upside. So one of the things we can look for is the full time frame continuity with actionable signals, and go back in time to look and see where the outside bars are. Now, in some software, what you can do is you can make it change color, and so that the inside bar is a different color and the outside bar is a different color. It helps you to see things. So in this case, I don't have that for you. What I can show you here in this ultra gigantic weekly triangle, if we go to the monthly, you're going to see this. This was a really good one. Higher high, lower low, higher high, ripping back through the range. I can stay long ultra against this is good for you. Bam, right, with full time frame continuity to the downside. Now, if we go back to that weekly, what we saw was that there was a series of broadening formations that would continue to trip into other ones, right? So it's not important that you have to pick the absolute bottom and the absolute top. You want to come ripping back through the range. And so in this case, outside bar has to be a broadening formation. When it got back into that, you're back into that triangle, right? So it comes ripping down through here. When it got through here, it kicked it into this one, this outside bar. That's enough more magnitude for you. Comes down. Once it takes that out, it kicks into this one. Boom. Here's your inside weak and say, oh, I totally missed the move. No, you didn't. This thing fell apart 250 down to 200 before it's finally taking out this outside bar, or see, this one, all these down in here, we're all gone. And at that point, then we can look for some type of exhaustion. But that helps you to identify where all this stuff is. If you can take a look at, say, Dunkin' Donuts. Right, Dunkin' Donuts on the monthly. Higher high, lower low, higher high, lower low. Comes back up, does it all the way back up to the highs, right? And then you can even have the sub triangle when it takes something out to any lower low or any higher high that gets reclaimed. That's potential broadening formation as when it combines with time frame continuity and actionable signal. In this case, Dunkin' Donuts goes inside month, inside month, and it did it after a lower low. After it went to a higher high, it goes inside month, fractal broadening formation, back into that. There's your magnitude, bam, takes it out. And so what you'll notice is that if it doesn't stay up here, then you're at risk. So in here, it starts to drop back in. So there was short opportunities there as well. Then it recovers and goes inside month and is now trying to expand that. If we go to, you know, and another thing that's important to remember is if you've ever made a little, and then have it all get wiped out in one clean shot, right? You gave it all back and then some. It's because of this, right? Because it trains your mind to think in terms of volatilities at a certain level. And it's no big deal, right? Oh, it doesn't go down that much. It won't go up that much. And then it does, and then it expands, right? And so similarly, if you've ever tried to put in a tight stop, right, and have the tight stop and it stops you out right away, and then you say the algos are taking me out, and you put a stop down a little bit further, and it comes down almost as fast and takes you out again, and you say, screw it, man, I'm not putting a stop in there, I'm not letting them have it, and you just get decimated, and there's nothing left to be long against. You just like, I can't take it anymore, and blow it out, and then it goes ripping back to the highs. This is what you've been seeing. So if we take a look at a few more, KRE, regional banks, higher high, lower low, higher high, lower low, because at this point, when it comes down here, you can see on the monthly basis, there's going to be a lot of a shorter term opportunity once we know this kicks in. And then you get down here for everybody, oh, it's the end of the world. This thing's never coming back until it goes inside month and starts rocketing back into the highs and then does it up again up in here. Also, what you're going to notice, and it's not an exact science, but they will become support and resistance higher. Most people will draw horizontal lines. That's false. Right? Because stocks don't trade in, things don't trade in horizontal lines. If they did, trading would be very simple. It would go 80, 82, 80, 82, 80, 82, then break through 82 and never trade 81, 99 again, right? And then go 82, 84, 82. It's not how it works, right? So anybody who's got trapped down in here is trying to get out, right? And so that's why over time, things will tend to drift away from you. Just like when you hold on to a loser, it tends to get worse, right? Same deal here. When people are trying to get out, the closer it gets to getting even, they're going to try and cover. SIVB is one of my favorites on the monthly. And the regional banks, higher high, lower low, higher high, lower low. We call this a momentum hammer. Here's an inside bar. And so once it starts ripping in through here, we can look for momentum signals, those shorter term inside bars, it's anything like that. And you'll see this here in Goldman Sachs. Goldman Sachs was good too. Because Goldman Sachs, another thing that you're going to see is even the way they work is people still appear, and I think I'll see head and shoulders, and so you get these guys going, see, there's the shoulder and the head, and there's that shoulder, and I'm like, okay, well, the thing about it is, it's still higher high, lower low, higher high, lower low, sub higher high, and then boom, whack, right? So the guys who are patting themselves on the back here, right, it's like, they're the guys who are still talking about this trade. Meanwhile, powering back up to the highs, broadening formation. Because if anybody's ever said that they've called a head and shoulders in any of the broader averages, because we've gone recently into new highs, they resolve to the upside. Therefore, the bigger move is actually up. And that's what you're seeing right here in Goldman Sachs. If we go to Dick's Sporting Goods, you're going to like this one here, higher high, lower low, higher high, lower low, boom, like here, inside month, back into the triangle. Do we know we're back in? Oh, hell yeah, we are. See ya. Toast. If you go to even cruder, Boeing's a great one. Boeing on the monthly was fantastic here. And so one of the things we also look for, remember, I'm not trying to get you to totally understand this tonight. Just grasp these concepts because this is how it works. The three universal truths of price action that cannot be disputed are time frame continuity, inside bars, right, and broadening formations defined by outside bars. You can't dispute any of that. That's how we can quantify all this and put it all together, as opposed to having a conversation on whether something's a buy or a sell. Either it is or it isn't. And so one of the great things about that is that when you can speak the language, what is the condition of the price as we know it? On the monthly, is it inside or is it outside or is it neither? Right? On the weekly, do we have any actionable signals? What are these confirming their time frames? All that stuff can be spoken quantitatively as opposed to having to sit in a chat room. Is that a double bottom? Is that a tweezer? You don't have to do that anymore, right? This is how it works. So some of the, even transports, UPS recently here, UPS weekly, you'll see it, weekly, bam, 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 back up. And so here you can even see it like this, like so. And you're going to see this outside bar, and you're going to see this inside bar. So they took them out. It's like lower low, higher high, lower low, inside bar, boom. It starts taking off, and we know there's an inside bar, outside bar here, outside bar. That's going to give us our magnitude that jets us into the highs. Crude oil, you can remember that. If we go back on the USO monthly, was fantastic. Even this falling apart, and I can get into more of that in the futures. But here, if you look at this, here was your lower low, your slight higher, inside slight lower low, then into the higher high, then went inside month. It also went inside week, right? And so for USO, not bad. 20 bottomed out below 8. But at that point, we also want to know what vehicle might we want to use. At that point, we had DWTI. So many of my people took that from the mid-60s towards 500 on that move, triple inverse. But as you can see, the continuation pattern, oftentimes people are looking for like this perfect pennant flag thing, of which almost never happens. What happens is anybody who's short's got to get taken out. We're going to take them out here, we're going to take them out here, we're going to take them out there. They're gone. All right, let's give them one more shot. Okay, now that you've cleaned out some of the short side, now you've got that magnitude back down, inside bar. Guess where the stops are? Here, 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 and here. Bam, take them all out in one shot. And some of the bigger moves, these cat tractor. Here's your monthly, higher high, lower low, higher high, lower low, go get. All right, nice move there. So another thing that people will tend to miss is that in real powerful moves, they'll say, well, Rob, and what about strong breakouts up to the upside? I'm like, well, eventually they will form something for you, a broadening formation. So in high growth situation, like NVIDIA, look at this. NVIDIA would be like, Rob, it went straight up. I'm like, no, it didn't. No, it didn't. There. It went up, and you can remember the beginning of this year. It went up, inside, outside. All right. This is another thing that I can talk about. Like I said, I'm just introductory to all this stuff. I teach this stuff. I'm on the headset 7 hours a day. Inside, and then an outside bar, and then an inside bar. And the reason that is important, all right, because a lot of people are trying to subjectively look at a chart. We want to look at it, what is the story telling us? What that tells me is a contraction in volatility, all right, an expansion in volatility by taking out both sides of the range, another contraction, and then here, right, another inside bar here, contraction. This actually took this out a little bit, slight lower low on the triangle. This got back into that and went inside. So if we go expansion, contraction, expansion, contraction, if that sequence continues, you get this. Bam. Contraction, expansion, contraction, real move. Did it do a broadening formation? You'd bet it did. It went higher high, all right? Lower low, higher high, lower low, slight lower low, inside and gone. And so that continuation pattern is something that we can look for as well in very strong cases, because we know eventually there's going to be some of that movement. The stronger something is, let's say that something's like going like this, how do I just get in on that? There will be this similar sequence as I showed you on the 1 minute SPY on shorter term time frames to get yourself in there, because if you're always trying to buy breakouts into new highs, you know that if it doesn't hold, you can get destroyed by that. This allows you to identify where there's corrective activity. So like with the UPS, am I buying straight into the highs on the weekly? I'm not, right? I'm not. I know I've had corrective activity because these bars are red. And now when it turns back green and I have these things to go after, 1, 2, 3, 4, 5, right? That's how we can go back into the broadening formation as opposed to straight momentum, if you will. So Sina, one of the bigger moves of the year. Let's take it out. And you'll see this, higher high, lower low, higher high, lower low, inside month, boom, gone, another inside month, and it goes almost to the tick. And when you do realize this, it's strange on how it does actually go to the tick, but running over, even though I got some extra time here, it sounds like, but most importantly, the reason that people have missed this is because of what they've been told. All the books, all the so-called experts say that this is rare, right? And all they do is regurgitating decades and decades of folklore just handed down of people not taking the time to sit there and do their own work. They're studying a lot of other people's old work, and it just isn't true. And so, as I was saying before, and I can exit with this, is that once you understand that there are 3 universal principles that govern all price action, then and only then can your work begin, right? Otherwise, you're going to jump around like I did when I started and say, well, sometimes this works in this condition, sometimes this works in that condition. No. You either have full time frame continuity to the upside or you don't, or to the downside. You are either in conflict or you are not. You either have these actionable signals, and I only showed you inside bars. We have reversals of those, which are equally as important. I'll show you that right here. This is called a reversal strategy. This is a 1 bar. See this? Inside bar, it went to one side, then came back through and formed another broadening formation here, right? Because this was an equilibrium. All right, remember that's an equilibrium. Couldn't take out the higher high, couldn't take out the lower low. So if somebody tries to take that and fails, that's something we want to know about. All right, that's like the kids on the playground. It's like if you take a swing at me and you don't hit me, I'm going to beat the crap out of you. And that's exactly what happens in this situation. So as I was saying, that time frame continuity cannot be disputed, right? It is either trading above all the openings or it is not. There's either an actionable signal in force, be it the reversal strategy, the inside bar breakout, or there is not, right? And that's going to be momentum, right? The fact that outside bars exist is proof positive of how many broadening formations there are and how ubiquitous it is. It's everywhere, because you can't dispute that an outside bar is a broadening formation on a shorter term time frame if you define it by taking out both sides of the previous range. No way. And so once you start talking and thinking like that, then and only then can your real work begin, because otherwise you're going to be climbing the walls and trying to try new things and I'm going to add this indicator to that one and this one. You don't have to do that. Then you just speak the language. And so one of the things about learning this and working with me and all the people that I've taught hundreds of people around the world how to do this, is that we don't have to have those other conversations, right? All we're doing, you can trade this all day long, right? These signals happen and occur so often we can't get to it all, right? Because this is the true nature of price action. And then you don't have to have those conversations. It's a matter of which ones have the better magnitude. Where can we get to fast enough? What's my risk parameters? I might not want to trade something like an Ulta. I can trade Bank of America. I can trade JP Morgan, JP Morgan, whatever, what have you. And you don't have chat rooms. And here you go, JP Morgan, the big breakout down here, down, inside, back up. And then once again came support, formed another one, and off it goes. So it gives you great confidence to know this stuff, because once you do, you don't care what anybody else thinks, right? It is what it is, all right? That's the best part about it. You don't have to sit there and be like, well, you got an opinion? No opinion. What's the fact? The fact is it's trading higher than an open on all time frames, which means I got buyers on all time frames, right? There's no question about it. I can't not. This can also be important when we're countering moves. Let's say that the S&P has full time frame continuity to the upside, but I have a stock that has full time frame continuity to the downside. that has to have natural sellers, real serious ones, because it's fighting the futures. And then when we can line it up with what I'm showing you here, unstoppable. So one last thing that I'd be totally remiss if I didn't get on. Where might this have the highest level of probability? Where could we use this where it would have the highest level of probability? It would be in some vehicle that we know has to trend in the same direction forever because of its construction. That would be VXX. And so once you combine with what I've just showed you, VXX, which is designed to decline over time because of how it's constructed, they have to roll the VIX contracts in this thing, which means it has no chance of going up over time. It has to decline. So when you can watch for them to come up and then come back through any range in this thing's always toast. It's our bread and butter. It can't possibly go up over time. You can look at TVIX. If you've ever read the TVIX prospectus, what it says specifically, this is for professional intraday hedging only. If you hold overnight, you can expect to lose money. If you hold to maturity, you can expect to lose everything. That's in the TVIX prospectus, right? And so when you combine what I just showed you, yeah, we can go fun and games on all the other stuff. That's great because you can see how much magnitude we can get. But when you do it on this, unstoppable, unstoppable. So on that point, I did go a little over, but I do enjoy talking to everybody. And if this is new to you, I know it's going to take a little bit to sink in. I've got a YouTube, Smith in the Black, all one word. I'm on Twitter, @RobinTheBlack. I'm at T3 Live teaching this. I'm on the headset 7 hours a day. I make a video every single night, a weekend video that's about an hour long, breaking down all the signals and all the triangles across the board, major sectors, down to the subsectors in the stocks, to make sure everybody gets it. I'll also go Wednesday nights for as long as it takes with an answer session on my chat room to make sure everybody's understanding how to track this. Because we not only am I on the headset, we also have an Excel spreadsheet of every actionable signal that is in force as we know it, right? We also have scans for all the major software trading platforms. And so we're scanning and just going all day long. So you can trade as active as you want, or as you can see, you can pull back on some of these monthlies for swing. You can use this for as active as you want to be.